Hello, everybody. It's Tortoise Investing coming at you today with another 5 dividend stocks that you can buy and hold forever. All of these are strong compounders. And in case you haven't seen the portfolio update, I own all 5 of these. I still feel that these are pretty well priced and I like them a lot. And maybe you will too. So we'll take a dive into the metrics and the finances and everything with them through Qualtrim Insights. But before I do that, if you are new, please hit that subscribe button. Let's try to get to that 400 mark pretty quickly. Video 100 is going to be coming out on Friday, so that's going to be pretty cool. And I checked the metrics. Like over 80% of my viewers aren't subscribed. So come on, do it. Just do it. Hit that subscribe button. I greatly appreciate it. I love everyone's support. And comment. I like communicating with you. But yeah, let's go ahead and dive into everything. We're going to be taking a look at MSCI, Tractor Supply Company, General Dynamics Corporation, Dollar General Corporation, and AbbVie Inc. Now, MSCI, I really like this position. It is so strong. It's such a strong grower. We have a free cash flow yield of 2.55%, dividend yield of 1.17%, and a payout ratio right at 44%. The thing I love about this is the growth behind it is ridiculous. Over the last 5 years, grown at a rate of 12%. That free cash flow has been increasing at a rate of 25.5%. Absolutely amazing. And the free cash flow correlates with the dividend, which has been increasing at a rate of 29% over the last 5 years. EPS is even growing right there at the rate of the free cash flow. They've been doing share buybacks. Over the last 10 years, been decreasing at a rate of 4%. The buybacks have slowed down here as of late, but they are still being bought back nonetheless. And that return on capital employed very reliably above 20%. Just so many things ticking right with this company up and to the right on pretty much everything. They do have some debt at $4.5 billion. Their EBITDA is $1.33 billion. It's a little bit more than what I would like, but with the growth and everything you get with this company, with this holding, I don't see that as being too big of an issue. I can't stress how much I love this company. All right, next up, Tractor Supply. I like Tractor Supply too. We go there quite often. Tractor Supply is down off of its recent high of 250, it looks like, down to 217. Take a quick look here at MSCI. Yeah, MSCI hit right at 570. So yeah, it's down to 480. And I'm trying to give you things that I feel that are on sale. So yeah, here recently, 250, it's down to 217. Got a free cash flow yield of 1.85%. Got a dividend yield of 1.9%. A payout ratio of 39%. Revenue growth over the last 5 years at a little over 14%. They do have some free cash flow here. It's been increasing a little bit slower at a rate of 9% over the last 5 years. EPS growing rapidly, right at 24% over the last 5 years. And the dividend, they've got a big hike thrown in there, which is going to be throwing us off a little bit. But over the last 10 years, an average of 23%. That is amazing. Such a strong compounder. And they just have a measly $814 million in debt. Their EBITDA is $1.7 billion. Absolutely just no issue whatsoever when it comes to the debt, which is one reason why I like this company as much as I do. Interest rates are high still, and they don't carry a lot of debt, so it's not something that's going to be impacting them as much. They have been buying back shares at a rate of 2.5% over the last 10 years. And the return on capital employed looks like it is slowly growing. So right there at 23%. Another company, it's so strong. A lot of good things. I like this one a lot as well. Next up, we got General Dynamics. Let's see here. Recently around the 250 mark, now down to 213. General Dynamics has a just free cash flow yield of 4.83%. Dividend yield of 2.49%, a payout ratio of 41.7%. So the revenue has been kind of flat-ish, but if you see here from 2020, it is slowly going up. They've won a bunch of contracts here recently, and it's on a lot better sell than what Lockheed Martin is, which was the other one I was looking at. And I just decided to pull the trigger with this one. And honestly, I like what I see with it. So free cash flow has been increasing slowly. Over the last 2 years, a rate right at 10%. Very nice. Like to see it. Over the last 2 years, over the last 5 years, been increasing at a rate of 4.44% with the EPS. They do have a little bit of debt. Looks like they've been paying that off though, which is nice. $7.6 billion in debt. Their EBITDA is $5 billion. No issue there whatsoever. And the dividend over the last 10 years been increasing at a rate of 8.9%. So if this one not as quick of a grower, but it is a defense stock, and defense stocks are usually pretty, without sounding cliche, defensive. These generally don't drop as much when there are drops. And I felt like I needed something to even out my my Microsoft, which makes up over 30% of my portfolio, and my MSCI, which I think makes up right at 20%. So I needed something to kind of soften the blow when there are red days. But yeah, they've been doing share buybacks, a rate of 2.23% over the last 10 years. And the return on capital employed looks like it is reliably above 11%. So another good company in my eyes. I like what I see with them. Moving right along, we got Dollar General. Dollar General, they have a really low free cash flow yield. That's my only red flag with it. But the thing with this company is it has been around forever and a day, and I don't see it going anywhere. I see it recovering from its recent drop. This thing was at $250 at one point, and they lowered their guidance for the year, and it just cratered. It's sitting at $160 right now. But let's take a look at it. The revenue been increasing at a rate of 9% over the last 10 years. Like I said, that free cash flow yield did take a little bit of a hit, but they said that they're not going to be doing share buybacks and stuff, and they're going to be trying to get this back in order, which I think they're going to do it. I think they're going to fix everything up the way that they need to. EPS over the last 10 years been increasing at a rate of 14%. They have very little debt. They have $5.7 billion compared to their EBITDA of $4.05 billion, so not a problem there. Over the last 5 years, been increasing their dividend at a rate of 15.26%. You can probably expect the next one to not be as much. The last one was, I think that's like, that's 9% or so. Last dividend hike. And I expect the next one also not be as big, but you know what? That's fine by me. I am eating this up at this price point. I am trying to add on as much as I can. Over the last 10 years, have been doing their share buybacks pretty aggressively, especially over the last 2 years, almost 5%. So yeah, that probably didn't help the free cash flow too much. So I like I said, I think they're gonna get things back in order. I like the company. These things are getting thrown up pretty much everywhere. There's 3 within like 5 minutes of my house in each different direction. So, I mean, I like them. I go there quite often. Return on capital employed has been around 13 to 17.6%. It looks like it's slowly going down, but, hear me. Last year was a technical recession, and then this year you're having the financial crunch with all the interest rates and stuff going up, so people are having to cut back on spendings because their bills are a lot more. The next bull cycle, which we're technically in one, when things get back in order, they start decreasing interest rates, I think this company is going to take off. Not financial advice, just my personal opinion. But yeah, I like them. Next, I've got AbbVie. AbbVie, don't you know? It's a really good company in my eyes. This right here has got an adjusted free cash flow yield of 9.36%. Hitting a recent high of, it looks like a little bit over $165, down to $138 currently. a very strong company in my eyes. They got a dividend yield of 4.34%. Their payout ratio is really around 50%, I believe, 55%. This is wrong. So revenue over the last 10 years has been increasing at a rate of 12%. Very nice. That free cash flow yield is growing as well, right at 15% over the last 10 years. Absolutely amazing. EPS been growing at a rate of 7%, and they do have some debt, but if you look here, since 2020 to 2022, they decreased it from 77.5 billion down to 59 billion. So they are chopping at their debt. Even at 59 billion, I think that falls in line with the 3 ratio here, or right at it. Dividend yield here. Well, the dividend has been increasing at a rate over the last 5 years at 9%. So, yeah, a good compounder, a great healthcare company in my eyes. I like what I see with them. Of course, the 2020 hiccup, but looks like things are growing right back in order. I can see that their capital employed is increasing. It's probably going to get right back to where it was for everything said and done. But yeah, 5 strong companies. I own all 5 of these. I'm not showing you something that I don't believe in. And these are 5 that I feel are down from their recent highs. And they all might be good, starting points. Let me know what you think down below. Again, hit that like and subscribe button for more. And on Friday, video 100. Until then, see you.